Gold prices have surged in recent years, and because of that, the same gold jewelry sitting in your locker can now fetch a much bigger loan than before. Sounds like good news. More gold value, bigger loan eligibility, quiet access to cash. But here's the problem. The biggest mistake first-time gold loan borrowers make is assuming that just because they can borrow more, they should borrow more. And that mistake can become expensive. So before you pledge your jewelry, here are 5 things you need to know. Number 1. Don't borrow the maximum amount. Thanks to higher gold prices and RBI's updated framework, lenders can now offer larger loans against the same jewelry. Under the current rules, loans of up to 2.5 lakh rupees can have a loan-to-value ratio of up to 85%. For loans between 2.5 lakh and 5 lakh rupees, the cap is 80%. And for the loans above 5 lakh rupees, the limit is 75%. In simple terms, if the value of your gold has gone up, the amount you're eligible to borrow has probably gone up as well. But eligibility and affordability are not the same thing. If you need 2 lakh rupees and the lender says you're eligible for 3 lakh, don't automatically take the 3 lakh rupees. The larger the loan, the more interest you pay and the greater the repayment burden. Borrow according to your need, not according to your eligibility. Number 2. Don't get distracted by low interest rate. Most borrowers compare only one number, the interest rate. But that's often not the real cost of the loan. Many lenders advertise attractive rates, sometimes starting around 8.5 to 12% per year depending on the lender and loan size. But that's only part of the picture. You may also be charged processing fees, valuation charges, renewal fees, and late payment penalties. That's why you should always ask for the Key Fact Statement or KFS. More importantly, compare the annual percentage rate or APR. The APR includes the effect of most charges and gives a much clearer picture of what the loan is actually going to cost you. A loan with a lower interest rate isn't always the cheaper loan. Number 3. Pick the right repayment structure. This is something many borrowers overlook. Gold loans don't all work the same way. Some require regular monthly EMIs. Some allow you to pay only the interest during the tenure and repay the principal later. And some other are structured as bullet repayment loans where most of the repayment happens at the end. Each option has its pros and cons. The key question is simple. How are you planning to repay the loan? Because getting the money is usually easy. Getting your jewelry back without repayment stress is the part that really matters. Choose a repayment structure that matches your income and cash flow. Number 4. High gold prices also create risks. Most people see rising gold prices as an advantage, and in many ways they are. But higher gold prices can also create a false sense of comfort. Because if gold prices fall sharply after you've borrowed heavily, your loan-to-value ratio can increase. In some situations, lenders may ask borrowers to bring down the outstanding loan amount or provide additional margin. This is one reason experts advise against borrowing up to the maximum permissible limit. Leaving some breathing room can help you avoid unnecessary stress later. And number 5. Choose your lender carefully. Remember, you're not just taking a loan, you're handing over a valuable family asset. So don't focus only on who offers the biggest loan amount. Pay attention to the lender's reputation, transparency of valuation, security and insurance of the pledged jewelry, customer service standards, and digital tracking and repayment facilities. Also remember that RBI rules require lenders to return the pledged gold within 7 working days after full repayment of the loan. So make sure you clearly understand the lender's process before signing any documents. When does a gold loan make sense? Well, a gold loan can be a very useful financial tool when used correctly. It's particularly useful for medical emergencies, short-term business needs, wedding expenses, and temporary cash flow shortages. Because the loan is backed by gold, approvals are usually faster and documentation requirements are often lower than many other forms of borrowing. But gold loans generally work best as short-term financing tools. They're usually not the ideal solution for long-term debt. If you found this video useful, like, share and subscribe to News9 for more personal finance explainers.